Hey, what's going on, everyone? This is Leo, and today I found a pretty interesting article. I was misinformed yesterday. I was under the impression that the vote for the SEC meeting would be taking place next week, and the meeting was today. But apparently, that wasn't the case. So they did end up voting through uh, the new transparency rules. So that'll be going into effect, and it's huge. And for those saying that it won't affect anything, well, I think this might change your mind. So, found this interesting article, and if you come down here, this is the most interesting thing to me, at least. Jennifer Hahn of Managed Funds Association, which is essentially like an association for hedge funds and private equity firms, claimed that the proposal could create unnecessary volatility, leading to situations similar to the GameStop market event. Now, this is somebody that works with the hedge funds. So it's kind of like those scenes in the movie where you have the bad guy and the cop and they're interrogating. He's asking him questions. Is it over here? The bad guy doesn't even flinch. Is it over here? Still doesn't flinch. Is it over here? Maybe he kind of shifts his he adjusts a little bit. He's starting to get a little nervous, but he's seeing it through the body language. What's interesting about this specific proposal is we're seeing these large funds fighting it vocally, publicly. We're seeing the document with Fidelity saying that, this could potentially expose the double lending of shares. That's a quote from Fidelity. Oh, excuse me. The quote would be exposing the double lending of loans. They didn't say shares, but we're talking about shares here. They just refer to them as loans to kind of conceal that a little bit. We're seeing Jennifer Hahn, Managed Funds Association, claiming that it could lead to situations similar to the GameStop market event. So this isn't just something that I'm saying to try to get views. This is the funds are actively against it. They're actively fighting it. They're admitting that it could cause a market run up similar to GameStop because we're exposing what they've been doing openly. Obviously it's been exposed to a certain extent with the due diligence that the apes have done, and it's that due diligence is convincing to some people. But this rule passing will show without question what's happening. So I think this is a big tell in the market. On to the next topic, something that I have no way to back this up, but this is just kind of an interesting theory that a friend of mine and I were talking about. It's interesting that Melvin Capital is coming out with these massive losses this month. And it's also interesting that, if you recall, Lou versus Wall Street was claiming that Citadel had transferred his shares off the books, or his short positions. Where did those shares go? So it's interesting that Melvin and Citadel have a history together. We know that Citadel did them a favor back in January by giving them that capital that they needed. So it has us wondering, did those shares get transferred over to Melvin? And he would be the fall guy instead of it falling onto Citadel. Just an interesting theory. I have no way to back it up until, obviously things would be exposed at the end of this, but something interesting, kind of tinfoil hat theory to think about. It makes a lot of sense that the loan that they got back in January would have an open-ended favor, quote unquote, and that would be the favors later on down the road. If they can't contain it, Citadel transfers them all the liability, and rather than having a bunch of funds going up in flames, that you would have this one fall guy. So just kind of an interesting theory. It doesn't really affect the squeeze or anything, just something kind of an interesting thought experiment. So in regards to the Fed, they ended up not raising rates. Not really that big of a deal. They're going to have to raise rates because whenever you have high levels of inflation, that's really the only way that they can combat it, is by raising rates, because it makes money more expensive, right? And so the problem with inflation is that there's too much money in the marketplace in combination with there being a shortage of goods. So it kind of falls back to supply and demand, right? If you have people with excess money, uh, and a limited amount of goods, well, they're going to be inclined to bid more or be willing to pay more for those goods. And so what you see is inflation. You see prices going up. So the only thing that the Fed can do to combat that is to reduce the amount of money in the economy, which naturally you end up seeing a pullback within the stocks, because the stocks essentially, they know that people will be spending less, which means they'll have less revenue. So it's essentially just a pullback within the economy. Um, but you don't want too high of inflation, because if goods become too expensive, then causes a whole lot of problems. People can't afford to buy a car, people can't afford gas, and it gets out of control. Um, so they will have to raise rates. There's no question about that. So um, I'm thinking that they're going to do it sometime around March. We'll just have to play it by ear, but um, and a lot of it's going to depend on how high inflation goes and how quickly it rises. We'll just have to kind of play that by ear. But um, yeah, that pretty much covers everything that I wanted to talk about in the video. As far as technical analysis goes, not too much has really changed. We're still pretty much where we were. I did find this other wedge here, falling wedge, that's rather interesting. And in relation to Elliott wave, it it's it it's not an ending diagonal, but it certainly looks like it because it has that contracting nature. But this wouldn't qualify. A couple of the things that you would look for in an ending diagonal would be, you would want to see your first wave overlapping your fourth. You would want the third wave to be shorter than the first, and then the fifth shorter than the third. It's only the wave system where you'll see that, where it just doesn't qualify. But it's interesting because it still has that same psychological effect in trading, where you're seeing the contracting nature within the price action. They can't push it higher, they can't push it higher, they can't push it lower, they can't push it lower, and so what you see is this contracting nature. So while it doesn't qualify as a true ending diagonal within Elliott wave, in regards to price action theory, it would be a valid falling wedge, which is bullish. And then we also have the larger falling wedge, which I've taken off just because this one seems to be fitting prices more neatly than the other one. So just have to keep an eye on it. There's a couple of ways you can draw it here. I always include the wicks. I know some people don't. So if you wanted to disregard the wick there, you'd be looking at this, but I don't really like doing that. I like to include all the price action, and that, from my understanding of technical analysis, is the proper way to do it. Price action theory is a little bit different. You can start looking at candle body closes more, but I'm predominantly an Elliott wave trader, so I look at the wicks. On a smaller time frame, if you're wanting to know when the trend change is starting, you can see all these different swings here, right? Swing, 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 swing. So what you're wanting, this swing here, you want to see us break above that. So we almost did. We need to push a little bit higher, put in a higher low. It'd be nice to see it come up, break through the EMAs cleanly. Oftentimes what I have found with EMAs is that if you get a break, and it's just a small break, so basically you break through the EMA and you kind of just chop around on the other side of it, it tends to fall back down. Doesn't mean that it's going to go lower. It just means that it falls back below the EMA. What I like to see is a clean break above them, and then a pullback to test the EMAs and then lift off. So, for example, you can see kind of did that here, where it chopped above the EMA just a little bit before continuing down. The same thing here, chopped around, moved down. This one, so this would be a difference in it, because you did shoot through cleanly, but you didn't get the rejection off the EMA. So it kind of started to chop around them and then broke down. So that's not something that I would like to see. But again, the biggest thing here is that the transparency's been passed. We have hedge funds coming out and admitting that, hey, what are y'all doing over at the SEC? This could potentially cause problems. It could expose the double loans that's going on. Essentially, synthetics is what they're talking about. That we have the Jennifer Hahn, I think her name was, saying that, hey guys, this could potentially cause run-ups like similar to what we saw with GameStop. Why? Because it's going to expose the fraud. With that, I will see y'all in the next one. If you find my content valuable, please like and subscribe, and I'll talk to you soon.